our best returns come from where we invest the majority of our time and effort. You have to come to something that's super different, that feels almost magic to the customer. They're like, oh my God, it's so cheap, it feels like magic. It works so well, it's like magic. The product so good, it feels like magic. Our original studio vehicle raised about $40 million to run as a studio.
Welcome to the Smart Venture Podcast. We're here to bring you the latest and greatest from the Silicon Valley, where unicorns roam and innovation never sleeps. We've got top investors, superstar founders, and well-known tech executives lined up to share their secrets on building and investing in successful companies. Just a quick disclaimer, while we may sound like financial geniuses, but please don't mistake us for your friendly neighborhood financial advisors. So let's get started and dive into the wild world of tech entrepreneurship. Thank you so much, Mike, for taking the time. You're an absolute legend. To start the show, I would love to, dig a little bit deeper into how you grew up and how you got to where you are. Okay, so for the audience, here are some contacts. Mike, I think you were born in Philadelphia and then grew up in Oregon, and then your dad is a financial planner and your mom worked in real estate as a founder, super successful, and which you kind of adopted an entrepreneurial spirit early on. And then during your second year in college, you founded a magazine, and then later on you sold a company to AOL. I believe you sold two companies and went to AOL, and then eventually you were the CEO of Myspace, and then you started angel investing, and then later on you turned your venture studio or maybe an incubator or accelerator into a fund. By the way, your most some of my favorite deals are Dollar Shave Club and Liquid Death. I just feel like those are just some iconic brands, and then you're able to hit so many interesting companies. I'm just today I'm so thrilled to chat with you.
Nice. Well, that's great. That's a great summary. Yes. And I'm super happy to be here and happy to share my experience on how that all happened.
What do you think were something that kind of motivated you to, start multiple businesses? And at one point you were able to just quit. Why do you kind of keep going?
Sure. So it's funny. I do a lot of talks with entrepreneurs and with a lot of students actually about kind of finding their path to entrepreneurship. And when I think about motivation on why people decide to take this path, I find that it really boils down to a few reasons. One is people want to prove something, they've been told they can't do something and they want to spend their life proving it. So there's definitely an ego component of proving somebody wrong. There's some people that wake up with a vision and they just can't not do it. So they're super connected to some vision and they have to spend their life and their passion kind of pursuing that. For me, I think it was really about control. I thought to myself, why do I want to be in a world where I rely on someone else to determine my future? I rely on my boss or the company I work for to determine my future. And I wanted my own controls and I wanted my own ability to drive my own personal success, both financially and in the career position. So entrepreneurship was really natural to me because I wanted that level of control. It was, it's illogical. It's not in the perfect sphere of balance and humanity. But for me, it was all about self-control over my destiny.
But I feel if I sold two companies, I already have a lot of control and capital. I would I don't think I would just sit in I don't know, by the beach all day. But I guess after that, the motivation probably. Okay, so before we going too deep on why you decided to work, I'm just curious, you have a pretty successful career. Who is on your personal board of advisors when it comes to picking which thing you do next?
Well, that's such a good question. Well, first off, it's I was really fortunate. I met my current wife when I was a freshman in college. So we've been together for a long time. We started dating in 1993. So, we're just rounding.
I was born not long before that. But
exactly. So I was born in 75, right? So for me, my first, board of advisor member is my wife, right? We've done everything together. She and I are complete soulmates. And so she's the first person I turn to whenever I'm hey, let's go learn quant investing, or let's get into crypto, or let's figure out public market stuff, or hey, I think consumer product goods are fun, consumer packaged goods, let's play. And so she's my first kind of core, board of advisor member. With that said, later in my career, I surrounded myself with groups from YPO and Tiger 21, different groups where I could have peer investors, peer operators that I could get reflections into. Over my career, I've had a lot of really good people that drove my career and really helped me. It could be John Miller, who was the CEO of AOL at the time that bought my company. He's always been a great advisor to me, to like legendary investors like Howard Morgan, who gave me a lot of advice on originally setting up Science as a fund. So like I've had a bunch of touch points, but certainly I'd say like the truthful answer is my wife was like, my life partner, and she's kind of driven me as my core board of advisors member.
Wow, that's so sweet. And like I feel like that's definitely lucky to have someone like just by your side to go through all these like crazy life journeys
Yeah.
together. What do you think is like one skill that you're constantly trying to get better at?
So for me, like I kind of went through three phases of my career.
Mhm,
The first, I would argue, is like I want to become a really good operator, and for
mhm,
me, that was all about like grinding and hours and
mhm,
like jumping the things you had no knowledge of and just learning it super quick.
mhm,
The second phase of my career was really about leadership. Like how do I learn to lead teams and motivate teams? Because as an operator and as a
mhm,
single small company operator, you kind of think you can do
mhm,
everything, but once you get to big problems, like within the MySpace situation, you have to be a leader, right? You really have to
mhm,
empower people around you. And then the third phase of my career is really in strategy. So right now, my focus is strategy, right? And strategy can be, like this morning, I spent a bunch of time with somebody who's an expert in the public markets and in the political sphere to understand how they think the world's turning. But it could be working with a CEO on something that's a very nuanced strategy on how to grow their business. So right now, I'd say I'm trying to get really, really good at strategy. Over my entire career, what I need to be good at is learning. Like I need to learn faster,
mhm,
right? I want to surround myself with experts. I want to learn faster. It took me a while to realize I didn't have to be the smartest person in the room. I didn't have to
mhm,
prove myself that I was the smartest person in the room, but I really did need to know how to get to the smartest people in the industry. So,
mhm,
my goal now is when I have a problem, how fast can I get to people that absolutely know the best knowledge in the problem, learn to trust them, learn from them, and then basically approach the strategy to solve whatever problem they're on. So collectively, I'd say that learning quickly is a big skill set that I constantly pushing myself on.
I love, like you mentioned, like literally four skills. That's like, being an operator, learning about leadership and like strategy. So like your first starting point was like you kind of like created this media company in college.
Mhm.
Correct me if I'm wrong. It's like a magazine and like in college. And like what were something that you kind of like learned at that phase? And do you feel like those like early kind of like school project or like school related like entrepreneurship experience kind of like shape you into a better entrepreneur later?
Yeah, I think the youthful entrepreneurship experiences
Mhm,
are probably the most valuable, to be honest. So,
mhm,
I was fortunate in that when I ended up in college, my parents were paying for my college. I went to a state school. I went to University of Oregon, which was a
mhm,
great school for me. It was really inexpensive at the time. It's really, it's collectively probably inexpensive now
mhm,
compared to like Ivy League schools or whatever. But
mhm,
luckily, my education was paid for. And so I found that what I did outside of the curriculum was more important for me. And the beauty of that school
mm,
environment was University of Oregon had this great campus with all these different resources and all these different people in a really, really small city. And that allowed me to go explore entrepreneurial ventures in this really protected space. And I
mhm,
remember thinking to myself as I was trying to build businesses, gosh, we're in this moment in time in college where like my food's paid for, my rent's
mhm,
paid for,
mhm,
there's all these resources on campus, printing groups and computer science teams and like amazing computer labs and all these computing resources. And then all this talent, designers and developers, and they're all just sitting around with their lives totally paid for and they're doing their schoolwork, but they have all this extra time. And I kind of thought
mhm,
to myself, like, gosh, you could build a business right now and you essentially have free labor and resources.
mhm,
And so I think that's true for most university environments, right? Is like,
mhm,
yeah, as a university student, you can spend all your time partying outside of classes, but you probably still have extra time. You certainly
mhm,
have extra resources. And so, yeah, I mean, I think what I learned in college was, oh, I could take an idea, I could
mhm,
gather a group of people, we could take on that challenge and try to start something from scratch. Success or fail, we're going to learn a lot. And so I became really
mhm,
comfortable with like going to 4 or 5 or 10 people saying, hey guys, I have no idea how we're going to do this, but what if we try to do this and let's just try it from scratch and figure it out. And that got me really comfortable at that 0 to 1 kind of moment, right? Which is really
mhm,
hard for people to get over. Oh, I don't know how to approach it, and how would I convince people? I got
mhm,
really comfortable with that in early days, saying like, look, I have no idea how we're going to do this. Let's just figure it out. And even though we went through a lot of iterations of figuring it out, that gave me a lot of confidence in the future to kind of start stuff that I wasn't maybe qualified to start, and that kind of put me on that path of entrepreneurship.
totally. I feel like a lot of these, like you said, like, in college, there's like free resources and free labor, as well as like it helps you get through like the 0 to 1 stage,
Yep.
which is like extremely important to
Yeah.
like, get yourself started. And like, I'm curious, like, later on, like you have sold your own companies, like, the real companies, and then sold to AOL, and then sold to other companies, like, and then you were running MySpace. You kind of like refer some, like while running MySpace, you refer the experience as kind of like, cutting a diamond with a butter knife. Like there were just like definitely a lot of challenges. I'm curious, like, what were like the learnings there to like, help you advise in the future, like, the Dollar Shave Club of the worlds?
Yeah, I mean, it's just, there's so many learnings packed within that very short amount of time when I was
Mhm,
CEO of Myspace for the few years I was. I mean, but if we're thinking about the top ones, one is, companies when they get to scale, they build a
mhm,
lot of redundancies, and those
mhm,
redundancies, if you have a solid strategy, are great, but those redundancies, if you have a changing strategy, are not great, right? It's kind of what you're
mhm,
learning through Twitter, which is, hey, we can fire a substantial portion of the team. The
mhm,
platform may not be as stable, it may not be as redundant, but we can move faster, right?
mhm,
And one of the problems is if you build up something really, really big and you build all this infrastructure around it, and then suddenly you want to change it really fast, that kind of counters what the organization's been taught, because the organization was taught to be stable, not necessarily dynamic. And so that
mhm,
makes it hard. The second thing I realized, like from a consumer perspective, is that if you build a big consumer brand, whether it's a
mhm,
social platform or a marketplace or a packaged good someone consumes, it's really hard to change the public perception of that brand once you've told the
mhm,
world what it is. So it's interesting to see Twitter say, okay, we're going to turn into X. Like maybe
mhm,
that's part of them saying, like, look, we really have to reset your perception of what this company is.
mhm,
But I basically found, and we saw it with Yahoo too. I mean, if you remember, there was a point at which Yahoo spent a substantial amount of marketing dollars to try to tell the world they were something that was different than we all assumed. And I would
mhm,
argue they weren't able to do it. MySpace, we learned the same thing, which was that once you're kind of a set vision in consumers' minds, it's a very expensive, if not potentially impossible task to change. So maybe that's a second big learning. I think the third is that companies have DNA. And if you build the DNA as one thing and internally, and you want to change it to something else, that's also very, very difficult, right? So
mhm,
so all these are things that I took away. What does that mean with like when you're looking at startups? Well, it means that like you can probably do things in a more dynamic fashion with less talent than you expect. Uh,
mhm,
Once you set a pace with large scale consumer marketing, you're kind of set in that pace. You have to be really cautious how you broadcast that to the world, and you have to have your kind of framework and parameters around it. And the third is if you build a company with the spirit of dynamic change and dynamic
mhm,
ability inside, that can build great. If you build the company in the spirit of like locked, long protected kind of movements, it makes it really hard for the company to change. And so definitely bring those problems to early stage companies. Those problems are certainly much more relevant to later stage companies.
mhm.
But it still kind of holds true.
Totally. I feel like those are some like really valuable learnings. And it kind of like remind me of like what you said about like when you invest in Dollar Shave Club, like one of the things that you like about the company was because of like the company's like super authentic. And then like, sometimes a consumer buy from the company, like basically you mentioned like, in the past, like people were buying from these like really big brands, like
Mhm.
their mom buy it for them, and the people want to like kind of rebel. Throughout this journey, like for building a company like this, how many stages do you feel like they kind of went through? And then how do you help them as an investor?
So let's see. Yeah, I mean, to your first point, like I think there was this moment in the 50s, 60s, 70s
Mhm,
where it was kind of like better living through chemicals, and these big
mhm,
brands were developed, and you kind of trusted products from these big
mhm,
brands. And I think what we saw now is that when you have a founder coming with a really genuine, a really genuine product and a genuine spirit,
mhm,
genuine brand, and they're kind of showing you a better pricing model or a higher
mhm,
value product with better ingredients, you're open to it. So there's a consumer moment that I think has kind of moved. That's probably a long-term
mhm,
consumer moment where there's this extra value going to less margin optimized, less big
mhm,
brand products. And that opened that door for a Dollar Shave Club or a Liquid Death, right? As far as learnings go, I mean, what I like about my journey so far is like, I've been the founder with 3 or 4 co-founders in a tiny
mhm,
little company, underfunded, bootstrapping, no
mhm,
investment dollars. How do we make payroll? How do we pay rent? Like, so I've been at that smallest stage. I've been at the middle stage of like, oh my gosh, we just passed 100 employees, and what does it mean? And oh my gosh, maybe we're driving profit, and we've got to raise. Oh, and let's start working with bankers. And then I've been at the biggest stage of like, oh my gosh, there's thousands of employees. How do we motivate people? It's a global operation, right? So I've been through the kind of 3 big moments. And so when I'm working with founders, like my different levels of experience will apply to them in different ways. And I can guide them through that. In most cases, if you were trying to ask like thematically, what am I focused on? I'm focused on, big level ups, right? So I'm not focused on 5-10% growth. Oh, that's great. I'm focused on areas where if we successfully do something strategically, we can double or triple the business, right? Like I don't need to get involved with companies that are growing at 5 to 7% per year. That's great. They're going to figure that out. They don't need my expertise. The question for me is like, how do we substantially change the trajectory of the company? And so that's small, medium, and large businesses. Harder when it's large, easier when it's small, easier when you have flexible founders that are willing to think out of the box. But I think collectively, myself and the entire team at Science, along with my co-founders, we're looking for areas where we can level up the business in substantial ways and get out of kind of a standard linear growth path.
Totally. How do you like substantially change something? And like, can you give us an example of like what have you suggested that they've done that kind of like shape them into like a bigger company?
I mean, you could substantially change companies through a bunch of different ways. Big strategic partnerships can substantially change companies. So if there's a company growing and we can ink a big strategic partnership, whether that's enhanced distribution, a celebrity sponsorship, a big influencer partnership, access to a platform that might have hard time getting access to, getting API calls into something you might not be able to get API calls in. So one is like enhancing distribution through physical, digital distribution and or marketing strategy, right? That will change the trajectory. The second is like taking a product that's applied to audience A and moving it into a more relevant audience B. So how do we change? Maybe it's still the core product, but maybe there's a better audience that'll be more receptive. Okay. So that's maybe another big strategic. Maybe the third is a substantial change to the branding and the positioning of the product. That can also gel with audience change, but sometimes we see great products that fundamentally have bad branding and they don't know their positioning, and we can potentially move them to a place that basically would find more traction and growth, And maybe the fourth is just rethinking the product in entirety, right? Like sometimes we come across things where like the founders think they're good enough, but argument it's not good enough. Like we need things that are 2x faster, 2x cheaper, 2x better, 5x more expensive. Like it's substantially different than its competitor set. And sometimes we find founders are like 10% better, 20% better. They're kind of finding some traction, but they can't find the big growth. So we'll look at areas where we can substantially change the product offering to make sure that it really stands out and connects with customers.
So from my outsider observation is like, I think you're amazing at like picking the brands that are like consumer related as well as like, I guess like have great advertising. So like, for example, Liquid Death literally is selling water, which is like the most commodity of all time. Like as a regular person, I would just buy water from like Costco or like just drink out of like the tap or something. Same as like Dollar Shave Club. I understand that you mentioned like when you see them, you are already having the thesis of like content is going to drive consumer at that point. Like I feel like that is a good trend. Like seeing the commercial, sure, I get it, but like without like seeing some sort of traction, like even if I meet the deal, like I would just like not recognize them. Can you just like program me into like how do I recognize them and then like invest in like the next generation of this?
Well, let's see. I mean, it's and just to be clear, like we probably incubate 10 big concepts a year, and I would bet one of those concepts ends up being like a really good groundbreaking. One way I think about it is how the products make you feel, right? So the moment I tell you, hey, plastic's super bad for the environment, and here's this alternative, which is like water, or in this case with Liquid Death, they also have iced teas, flavored sparkling water, but you're going to consume this water product, in a can, and you're going to recycle the can. And did you know that a substantial amount of aluminum that's ever been produced is still being recycled because the US has a really efficient recycling system for aluminum? The moment I tell you that, and it tastes really good, and you realize that the cooling nature of the aluminum can when it's cold just gets a better experience. So I'm giving you great tasting beverage. It's cold, which is just really pleasing to the experience. And when you recycle that can, you will fundamentally feel better about that commercial choice you've made. The moment I've shown you that, the next time you pick up a plastic water bottle, that's thin, crappy plastic, and you're literally dropping it into a trash can, you're going to feel really bad about yourself because you're going to know there is a better way where we're not just injecting tons of plastic into our ecosystem, right? So it might not be something you were aware that you were dissatisfied with, but the moment you do it, you realize there is actually a dissatisfaction because now there's a better way. With razors, what I would tell you is most people before Dollar Shave Club would buy a set of disposable razors, and they'd feel terrible about throwing out the razors, or they'd have their replaceable razor heads. But on the replaceable razor heads, what they would do, right, is they'd pick up that razor and they wouldn't replace that head for like 6 months. And they're literally in their shower and they're just like hacking away at their face with this like 6-month-old gunky, terrible razor. And what I know is if I send razors to your house every single month and you open your drawer and you are like, oh my God, I have so many extra razor heads. What you start doing is swapping that razor head more frequently. And every time you swap that razor head and you shave, you feel better about the experience. You're like, that was a better experience for me. And then because we've oversupplied you with product, you're going to swap out the razor heads way more frequently. And because you do that, it means you have a better experience every time. And then the next time you hold a razor that's been around for 6 months that you haven't swapped it out and you touch your face, you're like, this is a terrible experience. So once again, we're showing you there's a better experience on the, through our product and our process than the one you currently were using. When you were using it, you didn't realize there was a better experience, but now you do. Right. So we definitely look for products where after you consume that product or you get into our kind of product use cycle, it could be a mobile app, it could be a physical product, it could be a beverage, right? You realize at the end of that consumption experience, you feel really good about it. And you as a consumer have changed your relationship with that experience. And that's super positive. Right. And then you become a loyal customer.
Okay. So basically you're saying like because of like these companies have observed like a consumer behavior change and then they kind of just like really leverage whatever their observation and to like kind of like build upon it. So I think like one of my question is like, there's like some company that kind of like out execute everyone. Like one of the insight I heard from you that I thought was like really interesting was you mentioned like, for let's say like the Dollar Shave Club founder, like he just have like a vibe or like he have this authenticity to like take it to the extreme. And like, I'm curious, like what kind of characteristics like does these kind of founder have to make you kind of like recognize the person to do this?
And I think there's certain characteristics where it's, where it's universal and certain characteristics are very specific to the CEO. CEO and founders can be super different type of people, right? And they may have very different personality traits. I'd say one true thing for me is that the best founders are super connected to the problem. It's not just a person coming out of B school that has some great analysis on a market opportunity and they build an opportunity. Like they understand the problem, they're connected to the problem, they're solving the problem because they have the problem, they're going to solve the problem for themselves. And by solving it for themselves, they're solving it for others, right? So I really want founders that feel connected to the problem. I want them genuinely believing in it. And just like we know, startups are a really hard journey, which means that they've got to be passionate about executing that strategy because it's going to be a really difficult journey for them. And if they don't have that passion, they'll probably tap out and go do something else. The second thing for me is I really like founders where when they win, everyone feels really good about the win. Meaning like I want, if you invested in some founder, you met some founder, and 5 years later you read some article that they had sold their company for $1 billion, and oh my God, it was so exciting, and they made all this money. I really want you to say, oh, couldn't have happened to a nicer founder. They deserve that success. They work super hard. For me, that's important. Okay. There's certainly founders that make a ton of money and find a lot of success that people are like, oh, that person's terrible. And I really wish they hadn't been successful but I generally believe that like if collectively the network around you wants you to win, you have a better chance of winning. And so I like it when the founders feel good and they're super open and they're kind and they're generous. Their team feels good. Their audience feels good. Their customer base feels good. And when they win, society feels good about that win. I think for me, that's just it's a nice to have. It's not, like I said, it's not a complete roadmap, but it's a nice piece.
So I'm curious, like piggyback on like the idea of like which kind of founder can be a good founder, like, they're solving a problem for themselves. Like, how do you kind of pick the founder that can scale? Because I think my biggest fear is like, okay, so what if like they just wouldn't be the person who would scale it? Not any person, but like I would say there's a lot of people can make a great product. Like, when you go to like a farmer's market, you can see these like amazing soap or like
Yeah.
these amazing jewelries, but like, can they really scale? How do you kind of like take it to the mass?
Well, so I mean, on your first core question of like, it really goes back to what you originally asked me, which is like,
Mhm.
what am I getting good at? Like, I want to get good at learning.
Mhm.
Founders have to have that same approach because
Mhm.
going from that 2-person startup to that 2,000-person company is going to
Mhm.
require a lot of learning. And if you have founders that think, I've got it, my ego says I have to be the one to win. It's not about me elevating other people. It's all about
Mhm.
me. That's really hard to scale, maybe impossible to scale, and arguably the organization won't be super
Mhm.
structurally sound. So we want founders that are open to knowing what they know, knowing what they don't know, are completely comfortable admitting what they don't know, and then
Mhm.
hiring and attracting great talent to help them learn what they don't know.
Mhm.
So we want founders that want to learn, right? We do come across founders that are not that way. They're just stubborn in
Mhm.
their own beliefs, and sometimes those founders do win, but more often than not, they're very difficult founders. So
Mhm.
overall, I'd say we want great founders that can scale through learning, not
Mhm.
scale through just pure brute force. And on the like farmers market startup, that's a
Mhm.
different question, right? Like there's definitely
Mhm.
products that exist in boutique nature that might be fantastic big products. Maybe they don't have the right audience or advisory or kind of path to get it to scale, but we do see that stuff for sure.
Do you see, like, for example, let's say like a Liquid Death has like a really unique distribution channel or like strategy when they first start, or like those like kind of core things are developed later on because of the founder was able to learn, adapt, and stuff?
I think that like some of our product companies is exclusively on Amazon. Some go
Mhm.
to traditional distribution like in Liquid Death. We also have software companies that focus on pure app store distribution and mobile usage
Mhm.
or partnerships with third parties.
Mhm.
Um, every company needs to have its own unique distribution strategy,
Mhm.
right? It makes sense, however you're going to do it. And that kind of ties into however you're going to market, right?
Mhm.
Preferably you're distributing in a way that that incumbents or leading products or services are not distributing. So you found white space or whatever we call blue ocean for them to basically for you to focus in on. Super critical, and that's part of your core differentiation. I would say that one common theme is that whatever your strategy is from a marketing or distribution perspective, and most companies do really well if they test a lot of things, find the
Mhm.
one that's the most efficient, and then become absolute experts in that one strategy at the early stages. So, I've never found somebody that says, "Oh, I spend equal time on digital partnerships, Facebook,
Mhm.
Instagram, whatever." I
Mhm.
found ones that say, "Oh, we tried 20 things. This one thing was the most efficient. We put all of
Mhm.
our efforts to blow out that one channel, and we become really,
Mhm.
really good at that, and then we could go to the next one." So
Mhm.
a lot of times on early stage companies, what we're trying to do is push people to find alternative ways to distribute and grow, measure what's most efficient, focus in on that, and then use that as a core differentiator for them to kind of win that channel.
Yeah, like I think this is like a really interesting observation to kind of like test a lot of things and double down on something, being
Yeah,
able to like study the data and then like understand what's your like unique advantages
yeah.
through that channel. And I think like one of the things I thought was like really interesting when you were talking about the backstory of like some company that you've backed that are like went wrong. Like one of them is kind of a Tinder competitor, like you see the two companies in the same week, and then like one just went completely wrong. And then there's like the Blue Apron competitor, like
Mhm.
you guys hire a CEO, and then the CEO was like, no, like no more subscription. And what about like something that you've seen like the patterns of like a company that you back that did not like really make it as big? What were some common patterns of like these kind of like failed companies?
One is that the venture community has essentially selected a winner, and there's
Mhm.
really no funding for a number two, three, or four player,
Mm.
right? So, if there's two players already funded in a sector, you really don't want to go to market with the third, unless you're
Mhm.
massively different. But if somebody looks at your company and they're like, "Oh, you're just like X," and they raised $250 million, like that's going to be a really hard journey, right? So one is
Mm.
you're coming in late, you're coming in underfunded. Let's see.
Mhm.
A second challenge that we've seen are, like to your Blue Apron competitor, the lesson there is we took a legacy, well-known CEO that
Mhm.
was experienced in their relative sector. They knew all the rules, right? Which is, I
Mhm.
would argue, knowing all the rules sometimes is the worst, the worst quality for somebody because they
Mhm.
follow all the rules. So they knew all the rules, and so they said, "Oh, subscription will never work. I've done this before. I've tried it before. We're going to use this strategy, right?" And the reality is, we thought subscription did work. We
Mhm.
naively trusted the CEO that we had selected.
Mhm.
They were absolutely wrong. We were absolutely right. And the company,
Mhm.
right? So maybe the second pattern is sometimes when you take people who have been trained in a certain method, they're not really open to new strategies. And if the category is being redefined by new strategy, they may not, it might be better to get somebody that knows none of the rules.
Mhm.
Someone thinks they know all the rules,
Mhm.
right? Because think
Mhm.
about this, venture is all about disrupting the traditional, methods. So if
Mhm.
you're hiring somebody that is using the traditional methods, they're probably going to replicate what they know, and you're probably going to
Mhm.
get the exact same results that you don't want. So that's
Mhm.
maybe a second one. I think the third one goes back to what I was mentioning about differentiation. Companies that were 5% better than their competitor, 10% better than their competitor, like typically weren't bold enough. Their marketing wasn't different enough. Their storyline wasn't different, not enough to attract customers, right? And so I think you need to have massive differentiation. Your brand needs massive differentiated. The product offering needs to be differentiated. Preferably
Mhm.
pricing is also differentiated. You have to come to something that's super different, that feels almost
Mhm.
magic to the customer. They're like, oh my God, it's so cheap. It feels like magic. It works so well. It's like magic. The product so good. It feels like magic. And lean into that. But like slight differentiation, 10% better than, we've never seen big outcomes there.
I love the last one especially. I feel like, as a content creator, like, studying how some people go from like 0 view to like 5 million view within like a day or something, it's like really, really eye-opening because sometimes when you're looking at a lot of people's journey, they all started with like copying someone else's style,
Mhm.
because like people think that kind of like worked, and then a lot of people argue that like some biggest creators like went really viral because of they copy, let's say like a Mr. Beast or something. I just feel like in the consumer product, I do agree with you. You have to create something that people have never seen before to go really, really big instead of just a 5% better kind of version.
Yeah.
Um, I'm curious, like, when you're thinking about your fund, what are like the, 95% differences like you feel like you guys have made compared to other funds who are focusing on the same thing?
Well, see, I mean, so we typically we're a multi-stage investment fund. So
Mhm.
our first check is typically at the formation moment of the company, right? So we are
Mhm.
at the very first, typically dollar in. And I assume in most cases, our last check will be the check right before they sell our IPO, right? So
Mhm.
we want to be there for the full journey. What I found is that our best returns come from where we invest the majority of our time and effort. So when our
Mhm.
team can fully embrace a company and provide them with business development, fundraising, growth, strategy, hiring, structure,
Mhm.
board assistance, when we can touch all aspects of the organization effectively, we get our best outcomes. So when we're really in sync with that CEO and their collective team, and they
Mhm.
really see us as part of their core team, we typically
Mhm.
have the best outcomes. And then because of that, we're getting really good leverage on our time because we're spending a lot of time on that deal. And the more time we spend, the more dollars we want deployed because our LPs can be like, gosh, if you're spending a third of your time on liquid death, then
Mhm.
for us, it's all
Mhm.
about that long-term core engagement. And that's the most effective way for us to basically execute. As an angel, when I was cutting small checks into lots of companies, I had some great outcomes, which were fantastic. But I
Mhm.
generally find that from a fund perspective, if we want to be in the top 10% of performing funds, which is
Mhm.
absolutely our target, if not the top 5% within our class, we have to be fully engaged with the company to get there. We're not going to get there through a bunch of angel checks and then just playing the access game and hoping it's there. Like we're going to get there because
Mhm.
we put in a lot of time and labor with that business. We want to see them get to the end.
Got it. So like basically like similar to like a venture studio model. Like so I'm curious, like, okay, so in 2017 you guys raised like 75 million, and then in 2020 you guys raised like 100 million fund. So like throughout this journey, and then before that you guys were kind of like a accelerator or like kind of venture studio model. From these kind of evolution, can you share with us like what was like the early days like, and then what's the differences between like now you're running your fund like today
Sure.
compared to like the first day when you guys started?
Yeah, I mean, the kind of exact kind of path is we started as a studio, which is
Mhm,
essentially a venture fund that provides a lot of labor.
mhm,
And so our original studio vehicle raised about $40 million to run as a studio.
mhm,
Then as we started connecting with traditional LPs, we then raised a $75 million fund as a component to the studio. So the studio still absolutely exists, and the studio still absolutely provides a whole bunch of support and acceleration services
mhm,
for companies and stays involved in their entire journey. Our third fund, we actually only ended up raising 50. So we went out originally for 100 and we cut it back. So it was early COVID, right? So we have
mhm,
3 funds that we've officially raised. And then outside of that, we run a series of SPVs where for our top assets, we'll go and create special purpose vehicles to be part of their
mhm,
later stage rounds, right? So
mhm,
that's kind of the journey. We would never refer to ourselves as co-founders. There's absolutely CEOs that refer to us as co-founders, but the reality is
mhm,
the CEOs are the CEOs. They're the founders of the company. We are the back team here to support them in all cases behind the scenes to make sure that they can be super efficient at what they do. So whether you call us strategic advisors, whether you call us board members or investors, at the end of the day, I see us there to ensure the success of our core CEOs and make sure their companies
mhm,
get to where they want to go. Part of that support is a ton of capital. Part of that support is a ton of labor, right? Whatever we can basically provide to get them to where they want to go. But essentially, to your point, the first fund was structured as a studio. The second 2 funds were structured as funds, but the spirit remains the same. How do we provide a whole bunch of services and support to basically be engaged with our CEOs all the way up until they're at scale?
when you are thinking about like first of all, like I want to go back a little bit. Like you mentioned, like the first venture studio phase, you guys raised 40 million. I
Mhm.
know that you are angel investing, like you invest in like, Goodreads and like some other like good hit. I guess like I don't really know if you want to go into detail about like how do you shift between like angel investing to the venture studio, and then like I guess like how much do you invest until like what stage that you kind of like showcase your track record for people to give you like 40 million to deploy over like the venture studio model.
First off, is I think most people will not be able to raise for a venture studio. I think it's a really
Mhm,
hard structure. It's a really
mhm,
hard strategy to pull off. And there's only been a few of us
mhm,
that have really built hits out of it.
mhm,
So it's a pretty thin category. It's
mhm,
also a different category, but I think when you have expertise, it's great. I think
mhm,
if you have our type of background, and essentially myself, Peter Pham, Tom Dare, Greg Gilman, who are the original kind of core founders of science, when we started, all of us had essentially built and sold businesses to scale. So we're
mhm,
coming as pretty darn experienced entrepreneurs. Most of us, if not all of us, have also deployed a bunch of dollars personally in the angel set. Tom had taken companies public. Peter had obviously become an epic fundraiser, really known in Silicon Valley. So our backgrounds really lent to this. And
mhm,
I think like if you think you have that level of background and expertise, then setting up a studio is a great potential option for you.
mhm,
Most people don't have that kind of team or the patience
mhm,
to kind of do that. And a lot of times, remember, venture is about creating mass amount of capital that you deploy in the market really rapidly.
mhm,
A venture studio model is not that, right? Like
mhm,
we are not an assets under management game, right? Our game is
mhm,
how many billion-dollar leading companies can we build and get out to some exit point. Can we be
mhm,
the winner in that count, not the winner of dollars under management? So I don't sit here and
mhm,
judge myself. Like honestly, if you ask me what are my dollars under management, I'd be like, I don't really know. Like I'd have to go pull the number because we don't consider that. What if you ask me how many companies do you have in the portfolio that you think could have billion-dollar outcomes? I'll tell you that number because that's what I
mhm,
focus on is billion-dollar plus outcomes, right?
mhm.
So I think the venture studio model is very specific to the types of people that are founding the vehicle. I don't think it's like a normal thing, just to be transparent about it.
Mm. So like I guess, like, from that to, like, a fun, I'm curious, like, because today, like, we've always seen, like, there's, like, solo GPs everywhere, and then, like, I guess, like, the venture ecosystem also, like, shifted. If you're, like, starting a fund today, let's say you and I are starting a fund today, like, how should we go through this fundraising journey, and, like, how would you kind of, like, advise someone, like, young and ambitious to, like, start something like this?
Well, let's think like the reasons to start a fund, similar to the reasons of starting a company, right?
Mhm,
Either A, you have a different view of the world. So you're like,
mhm,
look, I have this view of the world. I believe XYZ country,
mhm,
XYZ sector, XYZ strategy is going to play itself out. And I want to engage in that. So you have something special that you're passionate about and you want to basically put capital against that passion. I get that.
mhm,
The second is you're like, hey, I've got special access. So in addition to a strategy, I have access to people that other people don't have access to. I have access to companies that have access to deals. And therefore my capital basically is bridging you into access stuff you wouldn't typically get, right?
Mm-hmm.
The third is expertise, which is really our storyline. I mean, certainly we have our perspective and certainly we have access, but we also have expertise. So our perspective is, hey, we have unique expertise and that's going to draw certain talent to us. And we'll be able to basically surround our expertise with that talent or surround the talent with our expertise. And then we'll get to really good outcomes, right?
Mm-hmm.
So maybe those are three logical reasons. You could also say my access is geography specific. So that could be another point, right? So the first thing is I want to start a fund because I have some unique one or many of those credentials, and that makes me uniquely qualified to do it. The second question is the construction of the fund, right? How are we deploying capital? At what pacing? At what size? At what stage? How much time is it taking? How many people does it take to deploy that strategy? And then modeling out, will we be a top performer if we successfully execute that, right? I think in the last 5 years, there's been a lot of people that have raised funds and they don't even have those initial potentially 4 qualifications of why to raise a fund. And I think they didn't have any sense of construction of capital. And they kind of, went cowboying out into the market, deploying a bunch of checks. And in a super positive economy, some of them might have done really, really well. In a difficult economy, I think they're going to struggle, right? So it's hard. But this thing I'd say is like, I believe the best venture capitalists in the world are ones that have built and sold companies, because I think that's the key, right? Building and getting companies to scale so you can sell your shares or sell the company or whatever. I think if you're jumping into venture without building and selling companies, you really should go back and do that. I think you'll end up being a better capital deployer than if you really haven't done that. So, if you and I were like, okay, let's raise a fund. Let's say you had built a bunch of companies and I had built a bunch of companies. We have a very specific expertise. I think vertical small funds are super interesting when you have people that are like, look, I'm super ingrained in biotech. I get access to something no one's ever seen. I have an intelligence no one's recognized. I have access to these very specific deals and I want to narrowly go after this. I think that's super interesting, right? I think it's more interesting than saying, we're going to do Series A broad consumer up and down the West Coast, any deal we can get, and we're going to take 1/3 board roles and 2/3 follow-ons. It's like, okay, you and everybody else, right? So for me, what's interesting is category experts that have a viewpoint and an access level that is really unique to them. And then I, as the investor, believe their viewpoint aligns with the market and the economy, and they're going to find something special that's going to make it a breakout. Like that's super intriguing. And that's, for young fund managers that are thinking get in the game, if they can tell that story, I think that's an interesting story. I'm not sure how all LPs respond, but if I was doing it, that'd be interesting to me.
I really like what you said about like, having a focus, like being, having either like a differentiated view, assets, or expertise, like basically having a really leveraging your unfair advantage to like do something that like most people cannot do.
Yeah.
And like, I'm curious, when you first started like angel investing, what were like the benchmark that you were using? Are you trying to make money from the angel investments, or are you trying to just like, be part of the game and then thinking about like, because you have like extra capital, so like may as well just like testing this thing out? And like, how was that journey like putting your own money backing some of the deals?
I was never in the game of buying access, so I wasn't logo collecting. I wasn't aligning with random venture funds for status, right? I was deploying capital personally for returns. Purely, right? And in that case, I was evaluating founders to the very same level. I mean, to a lesser sophistication than I value founders today because I have more experience. But I was evaluating founders off of founders I thought had all the things I just mentioned, unique qualifications, passion, all these kind of things. And then I was backing them, at what I thought was the right pricing. I was getting involved in whatever methodology felt right. And in certain cases, I had really good outcomes. I was super early with Scopely. That was a company that I was really involved in early days with the founder, had deep belief in him specifically. Otis from Goodreads, again, like very similar, awesome qualifications as a founder. So he had a unique skill set that I thought was going to be super intriguing at building a big business. That was super fantastic. And then there's a whole series of others, right? So like, both good and bad. But for me, I was evaluating the founder and the market and the exit opportunities the same way I do it now, just with less knowledge. I have more knowledge now, so I think I'm better now. But, I had good founders early days too,
Yeah. Like when you were thinking about like putting together your portfolio, you mentioned like 10 companies each year. You guys are incubating them or like helping them grow and investing in them. How do you like structure these 10 deals? What are like, because of like, let's say deal by deal as an angel investor, sure, I met like a great founder, let me put money in. But like nowadays, like, you're trying to make the fund make sense in terms of financial returns. How do you think about that to, construct a good?
What's super different is as an angel investor,
Mhm,
you're deploying your own dollars and you're not
mhm,
really doing industry level benchmarking against other people that have deployed dollars in
mhm,
2018, 2021, or whatever, and whether you did better or
mhm,
worse, right? But as a fund, we obviously do that, right? So
mhm,
for us, we're very price sensitive. We're very ownership target specific. And,
mhm,
what we're basically doing is mapping out what we think the next 5 to 7 years of that company looks like, their
mhm,
dilutive points, the pricing on their future rounds, the potential exit opportunities, and then backing it into a structure that we think gets us to the return that we fundamentally need. And then we're dovetailing that with our entire fund structure and seeing if the fund
mhm,
can hit to the target projections. Like, and
mhm,
it's not a light exercise. It's a very specific process. One of the core
mhm,
partners spends probably 50% of his time on fund modeling to make sure that we can come out there. So that when I go to my LPs, I'm like, look, this is how we think we're going to be a leading fund for you within this fund classification, if not all fund
mhm,
classifications. We can show them the exact math of how we think we get there and what are the core drivers, et cetera. So fund construction is a science relative to venture. Most people probably don't take it as seriously as we take it. We take it extremely seriously. At the end of the day, there's a lot of places to put money, right? Like beyond the
mhm,
markets and private credit and real estate and all the different asset classes, venture capital is a very small component of overall global dollars into investing. We have to outperform in some level of a consistent basis, which is really hard. And most venture capitalists will not be able to successfully do that. We want to be one of the ones that do. And if we work really hard at it, we get really loyal LPs, right? So it's not casual. It's very specific. It's very calculated. It's very formulaic. And the core for us is we stick to our strategy. So when all the prices rise in the market, we hold back. We hold our line,
mhm,
right? We do what we tell our LPs we're going to do, and we fundamentally believe that our strategy's better than others, and we expect that our
mhm.
returns will also reflect that, right? But it's not casual. You know what I mean?
Mm. Totally. What is like a trend that you see like in the future of venture capital? Since like there's so many solo GPs, my prediction is like they're gonna merge together in the next like I don't know 10 years because like how can you solo GP forever?
I mean, I think that what a lot of GPs will realize is that if they're young GPs with small funds, they will probably be more successful working at their portfolio companies versus funding their portfolio companies. I think what they're going to realize is that the carry game that is venture capital is getting rich slowly. And
Mm,
you may not want to be in that game if you're young, mid 20s, early 30s. Maybe it's better for you to found a business. And what you might realize is that, at that stage in life, VC is great for my stage of life where I'm really leveraging my expertise. But the reality is, if you and I were sitting at a table and you said, Mike, like, let's just go hard. And in 4 years, we want to find a way to make $100 million personally. There's the venture capital is not going to be your solution to that, right? Like at the end
mm,
of the day, it's going to be building a company, right? And relentlessly going after something we're passionate about that we think we can disrupt and sell. And I think a lot of people are going to realize that VC journey is great, again, for people like me, but for younger people, going and building companies and taking that risk and going on that journey is actually more fruitful for them. And then they can
mm,
become a VC later, right? Because
mm,
it's harder for me right now as an operator to compete against a 20 something that has no children and can just dedicate their entire life into crushing their
mm,
talk, right? Like I'm probably not going to be able to do that, right? But like I can be a VC right now super effectively and strategically crush my competitors in the VC world, right? From a return perspective. So
mm,
I think there'll just be a big switch. Whether there's consolidation, I think there's more of a realization that'll probably happen in single founder GPs that'll like, maybe they'll go a different direction.
mm,
Maybe they'll join their companies and maybe that'll be a great outcome for both the company and the fund and the GP. So that could be great.
mm. So I think like one of the things I'm curious about, like, we chat about like how to structure a good portfolio.
Mhm.
Um, I want to piggyback on that kind of topic is like, what will like investing in the next generation of Dollar Shave Club or like Liquid Death look like? What is Gen Z like in terms of like their differentiated shopping experience, as well as like, in general, like, what are some trends that you see in the industry to help you capture the next big deal?
Right. Well, from 1 to 3 years, from a direct to consumer perspective, right?
Mhm.
Amazon's incredible.
Mhm.
I think D2C moves the way of Amazon pretty
Mhm.
substantially. Companies that figure out D2C marketing with Amazon being their sales channel and really pushing all fulfillment and orders through Amazon, I think they're going to do really, really well. I think there's a big
Mhm.
efficiency coming there, and more companies will just launch on Amazon,
Mhm.
and they're not going to worry about their Shopify site. They're going to worry about their Amazon presence.
But why? I thought Shopify was like, where people are shifting to.
I think because Amazon's created a really effective ad targeting system
Mhm.
to drive interested consumers into new products.
Mhm.
And because of the overall data restrictions on Facebook, Apple, et cetera, around targeting,
Mhm.
it's just become a less effective program. And your dollars might be better spent within the Amazon ecosystem than versus through Facebook. And I think there's other reasons too. Fulfillment's probably easier. I think customers will just by default go to Amazon first, even if they discover a new product through Instagram. I think they'll probably go to
Mhm.
Amazon first to purchase it. I think Amazon is even a bigger winner than we probably know, relative to even new brands coming out. I think that I'm still a big believer in like vertical social networks. So like,
Mhm.
I think TikTok continues to be unbelievable. I think Instagram continues to be a component within our society, which is great. Obviously, Facebook as the core of Facebook.com has become less relevant to youthful consumers. I don't think email is going anywhere. I think there's always been this like death of email thesis. I don't think that goes anywhere. I think Slack continues to be pretty epic for individuals. And then obviously, I think the integration of AI absolutely everywhere becomes amazing. I'm still unsure who the winners in AI are. It's like when AWS came out, everyone was like, "Oh my God, let's build all these companies with AWS." AWS was the winner of AWS. It,
Mhm.
it made a lot of other people have less expensive infrastructure costs to launch their products, which is great. But like AWS was the core winner. I think AI for me is a big question too, is like, where's the core winner in AI? So I think a lot about those things. From a like longer term perspective, to be honest, I don't think beyond a 3 to 5 year basis. You know what I mean? Like
Mhm.
our stuff is really within the 3 to 5 year window because we're looking for things that get to scale within 3 to 5 years. I think the health trends are massive. I think people will move to low carb diets. I think that there'll be a pushback against alternative sugars. We're already seeing it. I think the biohacking longevity movement continues to be massive. I think people move from reactive to proactive healthcare. We're obviously already seeing that.
Mhm.
I'm not sure the U.S. maintains this mindfulness trend. I'm not sure whether meditation, really weaves its way into the like everyday format of society. I think that the startup landscape and ecosystem hopefully benefits small towns across America because I think that the remote work from home for highly talented people continues to be super effective. And maybe that benefits non-San Francisco locations, non-LA, non-New York locations with talented individuals that get paid really good wages. I'm super excited about that.
Yeah, I feel like I really like the diverse kind of angle that you're thinking. Yeah, I feel like it's definitely something we should all kind of like consider.
Mm-hmm.
Um okay, so we're at the last 1 minute fire round.
Okay.
So I have a couple questions for you. Number one is like, what's your favorite book?
So right now, I don't know if it's my favorite book of all time, but my favorite book right now is The Creative Act, A Way of Being by Rick Rubin.
Interesting. Uh who made the biggest impact in your career?
My wife made a big impact on my career. But
uh
I would also say John Miller did buy my second company and then elevated me within AOL and then eventually hired me over at News Corp to run Myspace. So he himself deserves a ton of credit for guiding me into kind of larger sales strategy.
who would you invite to your dinner party?
By default, I would invite my children and my wife.
Where can we find you outside of work?
You'll probably find me is like I try to spend at least an hour to 2 hours a day cycling, and then in the winter I spend an hour to 2 hours a day snowboarding. So I took my commute time, which was basically 2 hours a day in LA, commuting from Malibu to Santa Monica. I replaced it with outdoor time here. I'm much happier as an individual. So you'll find me outside 2 hours a day, and aside from that, this room that you witness is really my domain, and I spend 90% of my time here.
Nice. Oh my God, you have the dream lifestyle. I'm so jealous.
It's a dream for me. It's not a dream for everyone, but it's been a good dream for me. Yeah.
Amazing. Thank you so much, Michael. Really appreciate your time.
All right. Thank you, Grace. Take care.
Thanks for tuning into Smart Venture Podcast. If you learned something from the episode or even just mildly tolerated me, please subscribe and leave a 5-star rating. I promise I will keep bringing you more successful, insightful interviews and insider tips about startups. Remember, sharing is caring. So tell your friends to listen too, or enemies, I won't judge. Until next time, keep venturing smartly.